Right. So looking at the unit specification, last term, last session we have covered basically inputs into understanding, the general law and what side of law is applicable specifically in the financial accounting, management accounting field. So we looked at understanding, some of the bits on how a contract is formed, what are the 5 elements of contract. We looked at what are the principles of agency and its relationship. We also looked at another branch of law, which is law of tort, which basically looks at, if an harm is intended or if a harm is caused. So intended means if it is caused during the course of operations, and obviously if it is caused because of neglect, then negligence and remedies. And that side of law also we looked at, in understanding briefly, because it relates to sometimes when you provide services, sometimes when you look at, preparing accounts, if there are errors which happen because of negligence, then obviously in some cases, some of these errors can be expensive and, costly, because HMRC puts penalties on it. And the idea was to generally understand the law of tort and how and what part of it is actually going to be applicable when we look at the field of accountancy and, financial management. Then we'll also look at briefly merit and distinction criteria, which was to focus on, understanding what is the validity of contract. We'll look at discussing this in the assignment discussion session later, because in the assignment discussion session, there is a bit of a scenario given between Jody, her brother, and a buyer, and obviously she's intending on purchasing some furniture, but later on she changes her mind. So what we want to be able to do is, using that example, understand if the contract was formed and if the terms of the contract were valid. So here, what we've covered in understanding the elements of contract, what we need to be able to do is essentially in the merit task, take up an example, and with that example, show how how do we assess whether a contract is valid, whether it's a tenancy contract, an insurance contract, an employment contract, a service level agreement, or a contract between you and your client. All these would be essentially, prospective examples of how we look at assessing the validity of a contract. So here the example needs to be taken. And then in the distinction criteria, we looked at understanding, what were the implications of the agency relationship when as a principal you appoint an agent, and then the agent carries out the roles and responsibility or tasks which are laid out in the agreement, and how does that agency agreement actually work. So the agent, the principal, and the relationship which ensures or basically gets formed is called the agency relationship. And in the evaluation task, which is the distinction part, we basically need to evaluate. That means, again, look at an example. And in this case, there's another scenario given in the assignment brief, but we can pick up any other from our own knowledge. And that would be related to, say, for example, Day Loan Limited, a company which is basically looking at dealing with through franchises and agents which sell its services and collect money on its behalf. And what we want to be able to understand is the implications of that agency relationship by taking an example. So some of the merit and some of the distinction tasks that we look at in the unit are going to be extension activities, which will primarily ask you to take an example and show the application of what you've learned in the theoretical side of things when we look at some of the assessment criteria. So that is what we looked at covering in the first learning outcome. And today what we're going to be looking at doing is understanding company law and insolvency law. There are, again, a couple of criteria in this. So we'll be looking at covering these 3 past criteria, and we'll also be looking at covering 1 merit and 1 extension criteria, which is going to be distinction. There's a vast amount in terms of the indicative content that we need to look at, but they are broadly divided into 3 parts. 1 would be related to understanding what are the key requirements of forming a company. So what are the key elements which are required when you form a company? So sometimes what does happen in practical examples is that you have a client who comes to you, says, I'm looking at starting a company, or I'm a partnership, or I'm a sole trader, and he comes in and obviously looks at taking your services. So in some cases, what you would also do is, in some cases, you would look at opening a company, you'll form a company, you'll register a company, whichever way you call it, and what are the various requirements in terms of documentation and legal side under the Companies Act of 2006 when you create a company or form a company on the Companies House website. We look at going through that in a bit more detail. Then we'll also look at understanding what are the roles and responsibility of key people which are involved in the operations of the company. And these key people would be directors, shareholders, officers, or people who are appointed as directors within the company. Sometimes owners could be different from the directors of the company. But if you look at small businesses, sometimes you would see the owner is also the majority shareholder or person with significant control, as we call them in our terms, PSC. And they are also the key person who are managing the operations of the company. So we look at some of the roles and responsibilities. We look at some key areas in terms of what could be the roles and responsibilities. Sometimes as accountants or people working within this field, what we end up doing is we ask the owners of the company or the directors of the company to say, okay, could you also appoint a secretary? Could you also in some companies you would look at people also look at or companies' operations also require the appointment of non-executive directors. So we look at some basic idea in terms of what are the main roles and responsibilities which are required when we form a company, and who are the key people and what are their roles in terms of running the company operations. And then in the third part of this learning outcome, we're going to be focused on understanding the insolvency side of things. If the company is to go into administration, if we look at insolvency proceedings, which is typically when a company would go bust, or essentially would not be able to pay the debt, or an administrator is brought in from a point of view of looking at recovering certain charges. So when the company's operation become insolvent, that means it has insufficient assets to discharge of its debt and liabilities. That side of the process would be insolvency. So in some cases, some of these processes lead to court and court proceedings. And when a company is not able to, discharge its debt and liabilities, then what you will generally see is that the court would normally ask the company, or basically close the company operation down. In some cases, we look at those details of insolvency and reasons behind why insolvency can occur. So there we've got Adnan joining in. That's great. Now, quite a lot of indicative content to go through. Let's look at getting into by understanding some key bits of terminology. So if we know what is a company, sometimes when we look at the general word, and we come across this word quite often in the sense that when we create a commercial entity or a business entity which has a legal a remit of its own, and it can be separated from the ownership from a point of view of ownership in terms of directors. Hi, Adnan. So when you look at that, that is where you would generally see that the company as a legal entity would be required. So sometimes we see small businesses starting off as sole traders. We see a couple of partners or close, let's say, people working together in partnership. But at some stage, when they look at creating a legal or a distinct entity, then we will look at the formation of a company. Company could be formed under various circumstances, but when we look at basically this flow chart, which clearly depicts in terms of where and how the company sometimes is required, and in some cases when the operation of the company or the entity has to be separated from the ownership and the operations and roles and responsibilities of the director or the owner of the entity, then in those cases we will look at forming a company. Now, companies can be of various types. They could be private and public. So public companies would be companies which are listed or have shareholders. They may be listed on the stock exchange. And in some cases, when we look at the definition as per the .gov website, there are 4 different types of businesses. So you look at micro businesses with turnover up to 350K. You look at small, medium businesses with a turnover up to 3.2 million, and then you look at small, medium enterprises, turnover up to 6.5 million, and anything over that with more than 250 employees becomes a large company or a corporation. So when we look at companies, they can be formed as private and public. Sometimes you would generally see that when these companies are formed, they are unincorporated, and in some cases they are incorporated. That means they are registered and have full liability. Sometimes you come across this term, limited liability company. Any idea in terms of what is a limited liability company?
Yes.
Anyone, any idea?
Yeah,
Yes.
that is limited by the, for example, whatever we invested the capital, it is limited, not unlimited. Like we are responsible for a limit, and that's it. In case of
Yes,
like a problem or
broadly, yes, you are correct. So when I say limited by liability means what you're trying to do is limit the liability the company shareholders would have once if the company is to go into administration or insolvency. So that is why it is called LLC, Limited Liability Company, wherein in general, after the incorporation, what you do is you set the limit or the amount of liability which can be undertaken by the company shareholders, and this then forms a limited liability company. So there are different ways through which companies can be formed depending on how your business is going to be, whether they're going to register for VAT or you're going to wait for a couple of months for the operations to start, let the revenue start to come in. And at some stage, if it crosses a certain threshold, you get VAT registered and you start following some of the compliances. And that is what we are going to be looking at when we talk about, the formation of a company. Now, if we talk about, different types of companies, obviously, very briefly, if we have to differentiate between the two, public and private, public would be limited by shares. Private, if you look at, could be limited and unlimited. So in some cases, unlimited or incorporated corporations or limited companies do not need to file accounts because in some cases, either the transactions have not started, the company has not started to trade or is not in operation. But obviously, in those cases, you would look at unlimited company. And in some cases, when I say limited by shares, that means any idea in terms of when you say limited by shares, what do you mean by limited by shares?
so in that case, our shareholders they just invest money and they limit it like we will invest this much and that's it. In case of loss, we will just contribute this much money and that's no more than that.
All right. Okay. Anybody else who would want to contribute, saying what is limited by shares?
Well, it all means that liabilities of the company are restricted by the value of shares at that point.
That is correct. That's spot on. So when we look at limited by shares, the term that we use, which means that they are owned by shareholders who have certain rights, and in this case, their rights would be limited or would be limited by those shares that they hold, and against which they'll have some guarantees that they will need to look at in terms of roles and responsibilities. So essentially, sometimes you look at that, when you have companies which are formed, you would generally see that you make shareholders. So, the owner could be 50% shareholder. You have certain other managers or employees which could be given certain part of the equity, and that would lead to some sort of voting rights in the future. And depending on when major decisions are taken, which are related to, say, profit, trading, operating facilities, or, operations of the company, sometimes the number of shares which are there which define the person with significant control over 25%, then they will also entail what is called voting rights. But in short, this means that they are owned by shareholders, and it means that they have certain rights. And for example, in this case, the directors of the company may not be the shareholders, but in some cases, if they are shareholders, then they have certain voting rights to which they can agree to major changes happening in the company. Now, when we look at forming the company, most important part is that is where we differentiate public and private. So when we look at forming a public limited company, a minimum share capital of £50,000 has to be put and authorized in order for it to be able to, start an operation or, register as a public limited company. In the case of private limited company, there is no maximum or minimum limit. Normally, you would see if the companies are started or registered, you normally start with 1 penny per share. And if you're adding a shareholder, you'll add another penny in terms of share, £1, £1,000. Depends on, how people would go about registering, the organization or that entity. Now, there are differences, and that is where we will look at why public versus private limited companies are formed. But in essence, when we look at UK, for example, in UK, the small, medium businesses form the backbone of the economy, and there are in excess of 3.2 million, businesses which are registered as sole traders, partnerships, private limited companies with limited liability, and that is what ends up driving the economy of the nation. Apart from that, I think one of the other bits that we need to look at is that when we look at private limited companies, you need to have minimum one person nominated as the director. But in the case of public limited companies, you'll at least have a minimum requirement of 2 people who are nominated as directors. Now, some of these requirements differentiate how the companies are also formed. So when we look at the role of a secretary, sometimes in large companies you would see that the role of a person who basically looks at presiding on board meetings, taking minutes, or essentially coordinating between a number of directors and the shareholders and the directors of the company. You would generally see a secretary as a position is there. But in the case of private limited company, obviously, you would generally not have that requirement as a mandatory requirement. But in some cases, this allows us to again differentiate within, how the companies are termed as private and termed as public limited companies. Now, other requirements which we look at in terms of differences are, you look at accounts for public limited companies have to be audited. So any company which has a turnover of over 6.5 million, their accounts need to be audited by law. And if you look at private companies, obviously any business or an organization or a company which is restricted to a turnover as a micro business up till 350K or 356K, if I have to be precise. And then when we look at up to 3.2 million and up to 6.5 million for small medium enterprises, their accounts may not need to be audited until there's a requirement in some cases for organizations dealing with the public sector or utilizing public money or taxpayers' money. So in some cases, those requirements of audit or getting the accounts audited are not required. One of the other requirements which differentiates, and I know as a novice, before you get into the detail, is that all public limited companies which have shareholders and members of publics have shares in them, they need to hold an AGM at least once a year. That is a mandatory requirement. For private limited companies, sometimes you would see companies having turnover up to 6.5 million, they will have a secretary, they will do a board meeting, or if they are going to do a formal meeting, that would be documented and minuted. In those cases, you would generally see directors, owners, major shareholders, and non-executive directors actually participating in those meetings. But there, the role could be that the secretary would be presiding that meeting, and in some cases, when the operations do become large, you would generally see an accountant, or if you are an accountant, you would normally suggest your client to have a secretary which will take note of major proceedings or decision making which tends to happen, and documents this through the role of being a secretary within the organization. Now, briefly looking at when and how companies need to be incorporated, why they are considered as a legal entity. From a point of view of looking at, going back, if we look at, there is a rule called the Foss and Harbottle rule. Now, typically, where we see some of these proceedings and how Companies Act and all these were regularized, obviously, were done in 2006. But before 2006, companies were also there, and they were treated as what are called, the legal entities. But in some cases, when we look at how we have generally seen slowly and gradually over the years, decades, how this has now come into being as a law or an act, has happened because of various developments which have happened over the past decades and years. So one of the key cases that we look at, which is Foss and Harbottle's case, is a case wherein it was brought across in the 1842, in the early 19th century. And what we see is that 2 shareholders, basically, who are also the promoters of the company and directors, they allege that one of the other directors has appropriately embezzled the assets of the company, and that basically led to this particular court ruling that in order to manage the state of affairs of the company, and if it is going to lead to issues and problems which could arise, because there could be problems which could arise because there are various shareholders and different owners in a company or an organization, then in those cases it needs to be settled in the court of law. And obviously from that aspect, there has to be some law which actually puts some sort of a boundary around this. And over the years, what we've seen is that this has now been, kind of, let's say, encapsulated into the Companies Act of 2006, which was initially proposed in 2005, and then it became, an act after the passing in the Parliament, and this is what governs now most or all companies which are registered in England and Wales, or obviously there's a version of this in Scotland, in Northern Ireland, but generally you would see that, the Companies Acts of 2006, basically a combination of 1,300 sections, 16 schedules, and which basically provides all the laws, regulation, and legislation which is required to be dealt if the proceedings do not go as planned, and has to resort to the court of law or has to take matters to the court of law, then in those cases they are decided, and most of these are clearly written down under various sections and various schedules which now govern and are compiled under the Companies Act of 2006. Now, in addition to this, you would generally see that when we look at judgments which are passed in court, or we come across this word called judicial review, when sometimes you are challenging the state, or the member of the public is actually challenging one of the public institutions or institutions of the government, and you're filing a case or a review, and that is generally seen as a judicial review because you bring across a case against the state. And in those cases, when judgments are passed, and if rulings are upheld by the judges in those cases, then they are then brought forward in the Companies Act of 2006 as remedies. And some of these are then used in the future, or are become a part and parcel of the Act and legislation of the Companies Act 2006. So if some of these situations are to arise in the future, then some of these, decisions and judgments which have been taken could be used in order to, sort or look into certain similar type of cases or situations which when are brought across to the court of law. So what we see broadly is that after the Companies Act of 2006, when it was passed, what we do generally see is that the Companies Act 2006 is a comprehensive document which basically, after the passing of this particular act in the Parliament, has become a comprehensive document which forces into play the legal proceedings should the operations of a company, or should the workings of the company do not go as planned. And in this case, specifically in the UK, when we look at conscious of the fact that Odesh is based in Colombo, but when you look at specifically in the remits of the UK, when court proceedings are to entail, they normally would be governed by these 1,300 sections and 16 schedules under the Companies Act of 2006. So CA 06 in short, as it is referred when we do that. Now, in addition to this, the Companies Act of 2006 was also expanded in the, because of various elements of, companies being brought under the remit of Companies Act. So when we look at companies which are trading on the stock exchange or have shares and also issue things like bonds, debentures, and other instruments which are issued to the members of public, you would generally see that the security side of regulation was also brought in, and in this case we generally see Financial Conduct Authority. The earlier version of that was the Financial Services Authority, and that side of the regulation is covered under what is called the Securities Regulation. When we deal, or when we look at companies dealing in financial services, when we talk about financial services, I'm talking about insurance companies, banks and other, and these companies basically are covered under, because they provide financial services or look at products and services which are provided to consumers but cover under the financial services side of things, they are covered under what are called the Securities Regulation. And then when we look at how companies, some of these companies look at how, sometimes when they go into administration or when the operations of the company are no longer viable, you would generally see the Insolvency Act of 2006, which was added and, initially introduced in 1986. Over the years, the amendments to that act have happened. And what has then happened is that the Insolvency Act essentially allows companies to look at filing for bankruptcy. And in some cases, when we say administration, different meanings for different different words explain the same concept, but generally what we see is that companies which are registered under the Companies House and are not able to manage their liabilities and debts, in those cases, these companies follow what is, or look at, we look at winding up the activities of the company under the court orders, and then would follow in insolvency side of the law. So when we look at the Insolvency Act of 1986 and then further modifications or amendments to the Act, when we look at the Insolvency Act of 2006, is also, to be tied up in terms of studying and relating to the three major side of law or branch of law which will be involved in when we say law for accounting, or when we look at law which is, or law and legislation which is required to be followed typically when we look at dealing with companies and companies law. So you have the Insolvency Law or Act of 2006, you have the Companies Act of 2006, and you have the Securities and Regulation Act, which primarily is specifically required when we look at companies which are dealing primarily with financial services and are trading or basically listed on the stock exchange and deal in capital market. So in those cases, the Securities Regulation would be brought into also be looked at from a remit of coverage from a law perspective. One last thing which we also look at, and this is something which has now become a different branch altogether. Obviously, there are no limits or no specific, let's say the parameters or boundaries which have been defined. But what we generally see that corporate governance has also become a part and parcel of companies law. It is a separate matter altogether, but generally what we see is that because of the increasing awareness about things like sustainability, recycling, global warming, you look at usage of resources, in particular natural resources, and in the financial side, when we look at things which relate to over-reporting of profits, or say for example claiming or falsifying let's say financial statements which are printed in order to have, say for example, financial gains. One could be that, okay, if you're within if you're an employer or somebody who's closely associated with the company, that the company is going to report good profits or high amount of sales for this particular quarter, and if you are able to use that information and influence and look at buying shares or selling shares in the market, the company has shares listed in the stock exchange, then that will be using that information unfairly, unjustly. So that is where ethics, morals, and the corporate governance side of things come in. So that here the law essentially is related to understanding that sometimes when decision making is done within organizations and businesses, it should reflect just ethical and moral practices which are required, so that these practices are then followed primarily with from a point of view of looking at making sure that it meets the accounting standard, it meets some of the law and legislation which is required when some of the activities related to financial side of things, accounting side of things, preparation of statement side of things are done by accountants or financial controllers or people which offer these services. So corporate governance also is one part of this. It has become a specialist branch in itself. So when we talk about insolvency, it's a specialist branch. When we talk about securities and regulation side of things, this is a specialist area or a branch. And we talk about corporate governance is a specialist area and branch. And when we talk about companies law, which is related to the Companies Act of 2006, again is a specialist area or a branch currently. And you would generally see when we see matters leading into court, you generally see people coming across with backgrounds and expertise in taxation, in VAT matters, in corporate governance, in looking at the operations of a company from a company secretary point of view. So there are different areas in which how these interpretation of laws is done, and what we need to understand is that all of them, we need to have some sort of a broad understanding on these to be able to obviously, one, look at, let's say, informing our client on some of the key basic or legal requirements in terms of company's operation. Second would be to also follow and adhere to them from a professional code of practice, so that when you perform duties which are related to dealing on behalf of your client with HMRC or for payroll or for PAYE and other aspects related to VAT and corporation tax, you're following some of the ethics which are defined in the corporate governance side of things, and also under the Companies Act, which is what you're actually following and enacting on behalf of your client when you provide some of the financial services or accounting and management services to your customers. So in general, if we look at various laws and acts which are important that we need to be aware of, this is a bit of a summary slide. So we need to be aware of some of these laws and acts, because when we discharge some of our duties, we need to be at least aware that if there are things which fall under certain aspects of providing these services, then there are various acts and legislations which are important for us to adhere to and have knowledge about. So we look at the Companies Act of 2006, which is the major one. Then you have the Financial Services and Market Act, which is the FSMA of 2000. We look at the Insolvency Act. We look at the Criminal Justice Act, Companies Directors Disqualification Act. Sometimes you would see people become debarred from becoming directors of company because of various reasons. It could be reasons of, let's say bribery. In the case of, fraud, it could be reasons related to, let's say insolvency. It could be reasons related to money laundering. And in those cases, you would generally see that people become or are debarred from becoming directors of subsequent or holding directorship in subsequent companies, and that is covered under the Companies Directors Disqualification Act, CDDA 1986. And then we also look at the CICs, which are the Companies and Community Enterprise Act of 2004, wherein sometimes when you see companies who are registered as non-for-profit enterprises, social enterprises, or community businesses, or charities in some cases, and we get to hear a word called Quango. Have you heard of a term called Quango? Quango. Any idea in terms of Quangos?
Yes.
Right. So what are Quangos? Any idea, an example? So Quangos are basically semi-government organizations. So when we look at charities like Oxfam, or we look at some of the competitive bodies which government has created, like you look at OFWAT, we look at Ofcom, so the regulator for water, regulator for say electricity, OFWAT, and Ofgem for gas regulatory authority, which basically looks at the competition sides of things, or the Competitions Market Act, CMA side of things, in order to ensure that the consumer rights are protected and also the company rights are protected. So there are certain semi-government or let's say semi-public administrative bodies which are called Quangos, and they work at set standards. They are basically responsible for policing, or let's say ensuring that there's a level playing field, and both for the companies and organizations, and also for consumers. So sometimes you would see that they are also going to be covered under the remit of the Companies Audit, Investigation and Community Enterprise Act of 2004. So when I talk about CICs, essentially they are covered under that, and you would generally see that they are a body which is responsible, or the government helps form that body, but they have devolved powers, and they are partially controlled and financed by government authorities or government bodies or different departments, and that is where the role is to work as a pivot between the private or companies and organizations. I would not say private, but private public organizations, public sector organizations, and look into the competition side of things within the market to ensure that there's a fair deal available both for consumers and for organizations which are providing these services. So if we look at learning outcome 2, and if I have to summarize, what we're going to be looking at is understanding companies law, what are the various acts which are important under the companies law, and we're going to be looking at the insolvency law. And when we look at these are the 7 or 8 various bits of acts, law, legislation that we need to be aware of in order to understand and make sure that we adhere to some of the practices that we provide, or some of the things in terms of services we provide, you need to be aware of while we are practicing as a financial accountant or as a management accountant. And we need to be aware that these are legal requirements which have to be met. Sometimes when you produce documentation or produce reports which are filed on behalf of the client with the HMRC, Her Majesty's Revenue and Custom, or you look at, for example, VAT, or in some cases corporation tax, or PAYE in the case of personal tax, or payroll, pensions, things like that. And we need to be aware of some of these acts which are important from a point of view of looking at adhering to legal guidelines. So any questions on this so far?
No, everything is all right. Can't see any questions.
Great. Any questions at your end, Mr. Chima?
No question.
Okay, Aid, any questions at your end? Okay, and Udesh, any questions at your end? Okay, great. Now what we're going to do is obviously get into some of the specifics to discuss. After looking at broadly the learning outcome, we look at some of the specifics in terms of the assessment criteria. The first one actually looks at understanding, we need to look at understanding what are the requirements of companies law for the formation, financing, and administration of companies. So here, what we need to be able to do is basically get into a bit of depth to understand how companies are formed, what are the advantages of forming a private limited company, and in some cases, what are the bare minimum requirements and what are the documentation which is required to form the company. Now, broadly looking at, because we are using the word company here, so I'm not going to be getting into sole trader partnership and other types of social enterprise and charity. The task would look at concentrating on understanding how a company is formed. So when we look at companies, two types: private company, we look at public company, and in the private company, we can also look at the classification of limited liability company. So when a company is formed, or why do we look at starting a business or an operation as a company? What could be the various reasons why you would start up as a company, not as a sole trader or as a partnership? Any ideas?
We start companies sometimes because the biggest advantage is company is a separate legal entity, as we already discussed, and sometimes our liabilities when we have we are in company, then we can limit our liabilities in that case. That's why majority of people they start it.
Okay, that's great. That's a good point. Anybody else?
And there is one more point. Sorry, go on. Sorry.
Go on.
No, go on, Adnan.
So there is one more point as well. In companies, like whatever we are earning, if there is any profit, we will pay tax, and that will be a separate thing paying for tax as well. That could be the reason. Instead of sole traders, because there is a limit of 12,500. If we're going above the income, then we have to pay tax. That could be the reason why people they register companies.
Sure. Okay. So, Mr. Jima, any contributions at your end?
Yes, companies have a strong legal backing, and companies have distinct side of operations. The operations are clearly defined. You have a board of directors, or you have a managing director who is clearly defined, and responsibilities are clearly stated, so governed by the memorandums and rules of association, where everything about the company is stated in clear black and white. Unlike the private organizations or trader outfits, where your activities are not defined, you can give authorization whenever you want, and whatever you declare is what government will take. So it's not like that in the companies. Companies have, in terms of reporting, companies have a special format with which their reports are presented or financial statements are presented to HMRs.
That is correct. So in short, what we are going to look at is, when we look at starting a company, we are looking at 3 or 4 aspects. One is we want, as Anand said, we want the the operations and the liabilities of the organization to be separate from the owners or the shareholders. So that could be one of the reasons. The other reason that you've said is that sometimes when you look at sources of finance, in some cases when you look at partnerships, sole traders, you're looking at flowing your own profits in or your savings in, or you have limited sourcing for getting long-term sources of finance. So you could maybe arrange an overdraft, get a small loan, but when you have a limited company, you're obviously looking at the company borrowing from the bank, and there are various options available in terms of sources of finance. So legal entities, sources of finance, when you look at roles and responsibilities, again, as Mr. Chima said, there are differences where some of these are legal requirements, for example, publishing of accounts, the documentation and paperwork which companies submit at the end of the year is considered more authentic. And in some cases, you would also look at that in some, cases, certain information is a mandatory requirement, which is required to be published at the end of the year. And that is where, you would find companies' operations to be more structured and, more, basically more structured. So some of the advantages, some of the disadvantages of being a sole trader in a partnership would be treated as advantages for opening up a company, and you're looking at more structuredly an operation which will be, running for a longer term or a longer period of time, and there is more certainty around the decision that is used to form a company. So obviously a structure side of things, finance side of things, legal entity side of things, limiting or, separating the liabilities of the organization or the business side of the operations from the owner of the company. And those would be the reasons. And in some cases, you are looking at extending or managing credit or getting credit. So in those cases, it's easier for companies to get all these advantages or benefits as against, sole trader or partnerships. So what we've discussed essentially, is covered in terms of why we look at forming a company as against, or when we look at starting a business, we look at forming a company as against, some of the other ways and routes available to start operations. Now, one of the things that we look at within England and Wales, within UK in particular, we look at the company has to be registered with Companies House, and what are other various requirements in terms of when we look at forming the company. We would look at understanding that, the company needs to have a distinct name. We look at filing normally a form called the INO1, which is a basic, form that we normally used to pre-fill up until 2008, but most of it is now done online. But you can choose to send that form across to Companies House with the basic information related to the company name, the address of the organization, who are the directors of the organization, who the shareholders would be, and those are required to be captured, in the form INO1. So if I have to look at forming a company, one of the first things that I look at is look at this particular form. And this form, together with the Articles of Association and Memorandum of Understanding, are required, to be able to get an incorporation certificate from Companies House. Now, there are obviously, you can, let's say, provide your own Memorandum of Association, but in some cases, the standard, if you're not looking at making any changes to the MOA, then in those cases, when a company is formed, normally the MOA is a structured document which gets downloaded from the Companies House. If you're looking at doing it electronically online, or if you're doing it through a broker, in this case, it could be a company in the middle, or it could be an accountant. It is being done through the paper route. So you would generally see the MOAs tend to be standard, I think 35 or 40, I think 45, 50 guidelines, which are part and parcel, which you can download from the Companies House, gets by default, let's say, attached to your incorporation certificate until you've suggested certain specific changes, with regards to making those changes in those MOA before the incorporation certificate is issued. So when we look at forming the company, it is covered under, when we talked about Companies Act of 2006, it has, 1300 sections, 16 schedules. But when we specifically look at the formation of a company, it's covered under Section 9 of the Companies Act of 2006. So essentially, this is, a bit of knowledge that we need to have, so that when you look at filing the form or forming a new company, which is the INO1, the Companies Act, Section 9, 2006 actually covers the formation of a company in the UK. Now, what are the other things to consider? Some of the things when we look at, because this task is focused on understanding what are the key requirements for formation of the company, financing and administration of the company. So for the formation of a company, one, the form has to be filled. You need to have an MOA, you need to have the Articles of Association, and then other distinct things which are required before you go ahead and register a company would be a company name, which would either end in the word limited or LTD. This would be a unique name. This cannot be a name which could be borrowed or taken from any other company, or a trademark or a copyright for any other organization. And sometimes what happens is when companies get dissolved, or they are essentially dissolved, and the names still continue to reflect on the company's house, and if you decide to take up that particular name and start a new company, then in those cases, a special resolution under the Section 78 of Companies Act 2006 is required to be filled in order to look at voluntarily either changing the name of the company or adopting that name, which is from a dissolved or a company which whose operations have been wounded up in the past. Now, typically, you would generally see that after the company has been registered, you'd pretty much get straight away the basic parts once they have been registered, and that would be the incorporation certificate with the AOA and MOA, which you are able to download once the name gets registered. So let me ask this quick question before I go to the next slide and obviously discuss. Have you recently registered a company for either yourself or your client in the last 3 months, 4 months, 6 months, and a year?
Yes.
Yeah,
Right.
I have done as well. Yeah.
That's great. So when you look at the Companies House website, you're able to go in, select an option which is start a company. Obviously, it starts off with looking into things like, if I just very briefly show this, if you go onto the browser and you go on to the Companies House, it's starting a company, and most of the detailed information, is already published on the .gov website, which is how to register a private company, incorporation and, guidelines for naming of the company. There's a standard, Articles of Association and Memorandum of Association, which is available unless you provide something from your side, wherein there are specifics being provided. You would normally be using the templated ones which come across once the company is registered. And the process tends to be, quite straightforward. And if you have basic things in place, like the name of the company, the owners and directors of the company, the share capital which will be formed, if you're using the templated AOAs and MOAs, that's fine. You have an address of the company, that would more or less allow you to, create a company in about 15 to 20 minutes, on the .gov website. Now, let's quickly go through some of the other requirements that are required before when you are filling the IN01 form. Either it's online or, whether you're doing it manually and then sending it to the Companies House. The basic other requirements tend to be that you need to have at least one director in the case of a private limited company. You would need to assign at least one shareholder, and one shareholder would at least have one shareholding of at least 1 penny, and that has to be defined, when the company is being formed. The other thing that you will also look at is that the registered address of the company, or where this company would be registered in terms of documentation, in terms of any purposes for dealing with documentation or dealing with the address side of things would be required, and that is a must. And in some cases, when you have that, then only you'll be able to go ahead and complete that process of registration. Now, the other bits that we also look at, once the company has been registered, it's been running for a year. At the end of the year, you are required to file the accounts. You're also required to fill an AR03 form, which is basically a form that you fill on Companies House to ensure that the company's operation are running. You are required to file that form every year, depending on when your financial year end is. And then the accounts of the company has to be filed with the Companies House as a mandatory and a legal requirement. Now, if we get into understanding some of the basic bits of once the company has been formed, what are the roles and responsibilities of, key people within the organization? We look at, key people within the organization when we talk about shareholders. Shareholders are required because when we talk about shareholding, you would generally see that people would have voting rights because of the number of shares or the type of shares they actually hold. And when we talk about the type of shares and the shareholding, there are normally 4 broad types that we talk about. So when a company is formed, you will normally issue what is called ordinary shares. But there are shares which would have there are other types of shares which would be non-voting shares, preferential shares, and redeemable shares. So these could also be issued at the time of formation of the company. But generally speaking, when we talk about the formation of the company and the shareholding being assigned, what we generally see is that you would normally issue what are called ordinary shares, and these shares would be issued at to a certain value or a certain number, depending on how you're opening the company. Now, when we look at the roles and responsibilities of directors and the key people within the organization, so we look at directors, we look at secretary, and then we look at also one of the requirements, as I mentioned, which is called the registered office. So when we look at the directors of the company, in this case, the directors of the company could be different from the owner of the company. They could be people which are tasked with carrying out the day-to-day responsibility of the operations of the organization. If they are different from the owners of the company, or even if they are same as the owners of the company, they have a very specific task and roles and responsibility charter. And in those cases, some of the key requirements which have to be met is that, depending on the type of company being formed, a minimum number of directors have to be registered at the time of formation. There could be theoretically, there are no permissible limits on how many maximum number of directors you can have in the company. But generally speaking, for small companies, small operations, you normally have 1 or 2 directors. And in large organizations or in public limited companies, we generally see, a number of directors which are involved. And in some cases, you also have non-executive directors which are responsible for are a part of the board, and they are responsible for holding the directors in the operations of the company or the key people within the organization accountable as against what are the set policies and procedures within the organization. One of the legal requirements is that a bit theoretical, but one of the legal requirements is a person could be a director in the UK for a company as long as they are over the age of 16. They are not required to have a permanent residence or British nationality. They could have any other nationality, but they would need to have what is called a registered address or a permanent address in the UK. And in those cases, you would generally see that these requirements have to be met, specifically when we look at registering the company. Now, the role and responsibility of the directors tend to be that they are bound by duties and responsibilities in terms of the Companies Act, things like ensuring the ARO3 form is filled every year. If the company is going, accounts are submitted every year for the company. You will be looking at ensuring that the registered address and the operations of the company are filed, and obviously, relevant tax and other legal side of requirements are met, and they tend to be, the main responsibility of the directors of the organization. Now, some bits of these responsibilities could also be outsourced to an accountant. And in some cases, after the formation of the company, directors are mostly involved in running the day-to-day operations. But when it comes to financial and legal requirements, most of it is dealt by, the accountants if they have an accountant in the company or have appointed an accountant for the company. We look at sometimes when you form a company, we look at secretaries, and when you look at considering or appointment or considering and appointing a secretary in the organization, then in some cases, the role and function of the secretary tends to be that they are basically looking into minuting the minutes, key decisions which are taken, or key fundamental changes which are implemented into the organization have to be documented, and they would be tasked with those responsibility in terms of looking after what are called the administrative duties, of the company. So administrative duties of the company tend to be ensuring that, they are looking into any major changes which are happening, which could be related to, the shareholding of the company. It could be related to the finance of the company, the address or the registered address and location of the company, and in some cases, changes to the director and ownership of shares in the company. So they have to be documented, minuted, and in those cases, these would be some of the administrative functions which the secretaries would be responsible for. Now, one of the other things when we look at forming the company, it's a very clear requirement that we need to have a registered address for this entity. register needs to be the address which is normally used for sending off of or setting up of all formal documentation. And in case if there is legal proceedings which are applied, in those cases you would generally see the formal address or the registered address of the company is normally used. And in some cases this could be the address of the director, but in most cases companies really look at differentiating that address with either taking up a PO box or a shared office premises or whatever, but they normally look at keeping it as a registered address where all the documentation post related to the company's operation and affairs tends to come across. And in some cases, when a address has to be changed, you're changing the registered address, you have to inform relevant authorities. That means you have to fill up a form on the company's house, website. If you're looking at, say, for example, changing the registered address of the company, and that is a mandatory requirement, for you to be able to look into if you're looking at doing that. Now, in some cases, you would see that these forms have now all become electronic. So if you're looking at changing, the address of the company, your registered address, you're looking at filling up a form. Any idea in terms of what is the form? So if you're looking at changing the address of the company, it's called the AD01 form, which is required normally to be filled in if you're changing the registered, address of the company, which was used initially to register it on company's house. But most of these functions tend to be done now on the company's house website and could be done quite easily. Now, looking at the Articles of Association and Memorandum of Understanding, what we generally see is that, these are constitutional documents which are required, which are essentially, formed, or when we use the templated ones which are available on company's house, and they basically, provide details into the roles and responsibilities of the organization, the primary sector, or SIC. Do you know what is the SIC?
Yeah.
So yes. When we look at Mr. Chima, so when we look at the industry classification of economic activities, the SIC codes in terms of if the business is being registered as an education business, training company, accountancy firm, a trading organization, a retailer, as a shop, whatever you do, there are lots of these codes. You are a news agent, you are an advertising agency, a services company, a financial services institution, whatever it is. So there are lots of these SIC codes that we have to look at, and those are to be defined, and they are then reflected in the constitutional documents or the AOAs and the MOAs of the organization, and they tend to, cover or discuss or at least give a boundary of rules for a number of areas that need to be looked into, for appointment and dismissal of, say, directors. When a director is to formally resign, and you have to fill up a form, make sure that the company's house is notified. If meetings or the minutes are done, what are the voting rights? If the directors had any shares, have to be looked at. And all these things in terms of declaration of dividends, you look at communication with, if it's a small setup, then most communications tend to be, once a year, once a quarter. But if you're a large or a limited company with number of employees, staff, partners, suppliers, and you deal with a number of people, then obviously how some of these communications tend to happen, are also documented. And, issue of shares, if you add more shares to the organization, all these bits and pieces are covered in the Memorandum of Association of the organization. Now, in the Articles of Association, we look at basically covering things which are related to, in most cases when companies are formed on company's house, we end up using what are called the model articles. And these are articles which are prescribed having most of the standard terms and terminology as defined under the Companies Act of 2006. And in some cases, sometimes when you want certain changes to them, then you have to upload your own AOAs so that when the company is registered, a copy of that is also registered with Companies House, and they tend to be reflecting the changes that you've made in certain sections or sub-articles of the Articles of Association, depending on, what changes you have done. Either it's in the terms of, shareholding, or in terms of the types of shares you've issued. And those are the bits that are normally reflected in the Articles of Association. So if I have to ask this question and say, okay, in this particular task, if you have to look at the requirements of formation of a company, what comes to our mind very quickly is Form IN01, looking at basic 5 elements: name of the director, registered address, shareholders, if any, and a unique company name which is not either borrowed or a similar name under copyright or trademark with any other organization, and the MOA and AOAs have to be in place for us to be able to form a company. Some of the roles and responsibilities typically that we look at for directors, shareholders, and secretary could be defined, and those would end up covering this particular task, which is task 2.1. So any questions on this so far?
No. It's okay.
Okay. Now let's look at the second one very briefly. In terms of, it says analyze the roles and responsibilities of the key members which are, or key people which are going to be appointed as when the company or the company operations are started. So you look at company directors, you look at officers and shareholders. Now there are set specific responsibilities which are sometimes defined for under the role and responsibilities of directors. Now, if the director is also the owner of the company, then in those cases, the roles and responsibilities are also clearly defined so that they are differentiated, and we are able to differentiate the tasks which they are going to be carrying out towards meeting the legal requirements which are required as per the Companies Acts of 2006 annually to look at filing few statements, publishing of accounts, or any changes which have happened to the shareholding, directorship, or ownership of the company have to be reported. But when we look at the operations of the organization, then in those cases we would differentiate them slightly from the as journal duties of the director of the organization, because they would be more responsible for the operational side of things as against the legal side of things, which are more so from a Companies Act point of view. So when we talk about briefly directors' general duties and responsibilities of a company director, here we have to list down a few, and this could be done in the form of a few bullet points. So for example, if you opened a business and you're the owner of the business, you're looking at obviously, successfully launching the company, starting the company, promoting the company. You're going to be looking at obviously making judgments which will allow you to increase the turnover or get more business from customers, sell more goods and services that you're into. You'll obviously exercise due diligence, care in order to deal with competition and some of the other areas of conflicts which could arise depending on the classification or the code in which, say for example, in the sector in which you're doing the business. Now, some of the other indirect responsibilities tend to be, as mentioned, registration of the business for business tax purposes, whether it's VAT, pay, pensions, corporation tax, whatever it is. You're looking at filing the annual confirmation statement, which is generally the Form AR03 on Companies House. You're looking at filing accounts with Companies House. Returns of the company have to be done if the company has made profits, obviously liability in terms of submitting tax. Any idea in terms of what is the corporation tax in the current year?
Is the rate you're talking about?
No, corporation tax.
In the current year, the tax year is 19%.
So the current corporation tax in 2021 is 19%, sorry, yeah. And it is slated to rise to 25% as per the Chancellor of the Exchequer, which has made some changes this year in the budget, and it will rise up to about 25% by 2025. Now, any other indirect responsibilities which sometimes are shouldered by the accountant would be things like, reporting any major changes to ownership, person with significant control, as we say, PSC, or in some cases, change of directorship, ownership, and, in some cases, registering for self-assessment. So all these are indirect responsibilities which could be done by the accountant. But generally speaking, in very small organizations which are 1 to 5 or 1 to anything less than 10 employees, you would normally see the company owner or the owner of the organization also being the director of the organization would end up doing some of these responsibilities, and some of these would be done by the accountant. Now, apart from that, what we are also looking at is the director of the company has to be very clear and look into things like understanding what is unlawful discrimination, when we look at areas or, let's say legislation around pensions, work, requirements, we look at, say, for example, if you're a company who's doing import-export business, or if you're a company which you've registered a company and you're basically operating here and outside the UK, and your people who come into the UK, or you employ workers which are outside and not having British nationality, then you need to be aware of, obviously the law and legislation related to, workers' right, and, how some of these workers who would be allowed to work within the UK under what visa and other conditions. And in some cases, some of these responsibilities are outsourced to either solicitors or firms which act on behalf of the business, and you pay services or service charges for them to be able to manage that. Now, if you're a company into production manufacturing, you look at things like health and safety concern, environmental breaches. In some cases, we will also look at you being aware of things like if you are a business in terms of financial services. When we look at if you are having a franchise of Western Union or MoneyGram, for example, which is a business which uses or provides services which allows customers in the UK to send money abroad to their parents, relatives, friends, businesses, whatever. So in those cases, you need to be aware of things like money laundering side of things, bribery side of things, enforcement side of things which are required, and those would be the responsibilities which will fall on the shoulders of the director. Now, in certain circumstances, if you're found in breach of some of these duties, which are serious, when I say duties means serious offenses like fraud, bribery, money laundering, then sometimes under and if you land up in the court of law or against HMRC brings on a case, then in some cases the CCID, the company's Directors Disqualification Act, CDDA, can debar the person from becoming a director in another company for a period of up to 15 years. So these are when I say some of the activities under serious breaches, things like when you're involved in theft, fraud, bribery, money laundering, terrorism financing, these tend to be, or tax evasion, then in those cases the directors could be booked under serious offenses, and in some cases the penalty, apart from fines, imprisonment, tends to be also disqualification or being banned from becoming a company director, for a period of up to maximum 15 years. Now, when we look at duties of shareholders, the shareholders of the company are effectively, financial supporters, people who bring in the capital, people who initially bring the seed capital, which is going to be employed in running or starting the operations of the company. In a way, they basically look at providing finance, which would be required for starting up the operations of the company, and their general responsibilities would tend to be, when we talk about shareholders, they attend meetings. They would normally have, depending on the types of shares they have, voting rights. They would also receive, company dividends or profits. If they are shareholders, essentially they will receive, some sort of a dividend at the end of the year. If you are an owner and a director of the company, then in those cases, if the company produces profits, then you will take, you are allowed to obviously take profits under the dividend side of things, from a point of view of, taking out profits from the company. So slightly different here. So in this case, shareholders would be liable to get dividends. The company, in some cases, declares dividends. Normally, we see them in large public sector organizations or public limited companies. But in businesses which are, small, medium enterprises or businesses which are turning up to 3.2 million, you would see normally there would be shareholders in the organization or the business, and they would normally receive dividends at the end of the year because the company is, trading well and obviously producing profits. And these, one of the key responsibilities tends to be, when we look at shareholders, there's a term called preferential shareholder. Have you heard about the term called preferential shareholders?
Yes.
So what are preferential shareholders? Any idea?
Yeah, these are a group of shareholders that are given exclusive rights. For example, in terms when the company is dissolving, these are the people that should be settled first.
Absolutely correct. So the bit that you gave away spot on was They are preferential shareholders because they're given certain preference or rights. And when we talk about these preference shares, they come with, they have basically people given these preferential shares would have certain specific rights or preferential rights to get dividends during the lifetime of the company. They would also be looking at getting some return on capital when the company is wound up. They would become the first, or they will, when we look at classifying liability for the company when the company is being wound up or getting into insolvency administration, you would see preferential shareholders would be given more or preference or precedence in terms of receiving what they are due before the proceeds or the dissolution of the company proceeds are shared with, other, people within the organization, which could be employers, suppliers, partners, directors, things like that. Now, so here in this particular task, what we need to be able to do is in 2.2, we are looking at analyzing or basically putting advantages, disadvantages, getting into a bit of detail in terms of roles and responsibilities of company directors, some of the shareholders and officers of the company, which could be the owner or, say, for example, employee of an organization. So this task is a little bit descriptive, but the idea here would be to look at, getting into the key terms and which is roles and responsibility, and look at defining that using either a table or a paragraph with some bullet points to cover this off, wherein you are looking at talking about the role and responsibility of the company directors, owners, and shareholders, and that would end up completing and achieving this particular task. Any questions on this?
No.
Okay, so let's look at now 2.3. Now it talks about explain the process of insolvency for a business organization. Now, as we discussed earlier, when we talk about the, let's say the meaning of the word insolvency, what we basically mean by that is that in this case, when we look at the company's assets and liabilities, are not, let's say the liabilities of the organization become more and the company is not able to then, pay off its debtors, then in those cases, what we generally see the process of insolvency actually comes in. Now, when we talk about insolvency, what we also mean is that there is financial distress. That means, the business in this case or the company in this case is unable to pay the bills. So sometimes you would see companies take out bridge loans. They take out, some sort of additional funding. In this case of when we look at the pandemic, COVID-19, what we generally see is that the government has authorized the business bounce back loans, for small organizations, big, medium organizations, and large organizations in terms of, in order to help tide over this trying period. So companies have been offered loans at almost 0% interest for the first year, and then, a small interest after that. And the government has extended that period for the companies to be able to pay that loan back for up to a period of 10 years as against the standard 6 under the bounce back initial loans which were issued. So when we look at the process of insolvency, what I mean by insolvency is what comes to my mind is that if the company or any organization is not able to discharge of its debt and liabilities, and then a winding up process or a liquidation of the company starts, then that process is called insolvency. It's covered under the Insolvency Act of 1986. It obviously is financial distress for the organization of the business or the owner of the business, if the owner is also the director of the business. And in this case, if the liabilities and debt are in couple of hundreds of thousands of pounds, depending on the business, I can't generalize this, but generally speaking, in those cases, if the proceedings are taken to court, then the process through which recovery of money happens for the shareholders, for the employees, for the partners, suppliers, or people which are owed by the business is done through the process which is called insolvency. So companies become insolvent, person can become insolvent, an entity, a business or an organization can become insolvent, and the assets are then liquidated to pay off the outstanding debt, and that process is called the insolvency process. It is covered under the Insolvency Act of 1986. Obviously, there are amendments which have happened over the years, and the updated Act of 2006 works very closely or is incorporated very closely with the Companies Act of 2006. So in this particular task, we need to explain. That means we need to theoretically explain the process of insolvency, or what are the steps which are involved in the process of insolvency, or the process of winding up of the organization by liquidating the assets of the company to pay the outstanding debt. And we need to go through this bit in terms of understanding what is the process of insolvency, what is administration, what is liquidation of a business. They all tend to be different terms used under the connotation of when a business is under financial distress, is not able to pay off its debt. And in those cases, what we will look at is we will use different words to depict the situation, or, to talk about the situation of the company at any given point in time. If the company goes into the process of liquidation, then that process will be called inlet solvency. If the company is still trading but is unable to pay its debt and calls in the administrators or organizations wherein it then tries to protect its financial assets and intellectual property and calls in the administrators before the court proceeding starts, then in that case we would term it as administration. So a process which basically looks at facilitating and rescuing of the company when they are financially under distress or trouble, and that would be administration. We generally see sometimes companies going into administration and also coming out of administration because they've done restructuring in the organization. And when I say restructuring, we are looking at reading it from a point of view to be able to allow the company to repay that money over a period of time with some interest costs, allows the company to continue trading, come out of administration, and in those cases we will term that process as administration. So when I say winding up, when I say liquidation, when I say administration, they could be seen as three different phases through which an organization or a business can go through, and liquidation or an insolvency side of things would be the most dire consequence. Administration side of things could be somewhere in the middle if the company's director and the owners are able to reach some sort of a compromise with its creditors, bankers, and it allows them to restructure their debt. In those cases, you would see companies goes into administration, comes out of it successfully after restructuring the debt, long-term debt, and that allows the company to continuously trade and obviously, continue operating in the market. You would also see that sometimes when we look at insolvency,
Excuse me.
Yeah, go on.
Excuse me.
Yeah.
Can you explain again the difference? I understood administration, I understood liquidation, but you mentioned something like winding up. So what's the difference between liquidation and winding up?
So when I say liquidation and winding up of the company would be when, say, for an example that I would give you is that the company has had some county court judgments. One of the creditors of the company or debtors in this of the company has actually gone to court, and you're trying to wind up the operations of the company, but the court proceedings, because the person has gone to court and has taken a legal recourse in this case and has stopped the company from winding up its operations. In those cases, you would generally see that we would use the term winding up. The winding up of a company could be in some cases, what happens is if the company goes into administration or liquidation, sometimes the company directors and the owners would sit down with the major debtors and would reach an agreement. Liquidation of the assets would be able to cover some of the, bits and pieces of how the company operations is to be closed. And that allows the company to go into basically do that side of the process, which is insolvency. Then sometimes what happens is the winding up process, which means the process of closing down the company by sending in a resolution to or notification to Companies House that the company operations are being seized, or the company is being wound up, or the company is actually being closed in terms of dissolving the company. So when I say winding up, what I mean is it's a process which is looking at dissolution of a company. So when you are looking at ceasing the name operations of the company altogether, then you would use the term winding up. So sometimes you would see that the process of liquidation would go on for months or even weeks, and months. You would see company would go into administration for a week, month, a few months, even a year, and then come out of administration successfully after restructuring of that. But when none of these recourses actually work, you would generally see that the winding up process, which means the dissolution of the company, would be started, wherein the business and the business activities of the company would cease to exist altogether. And that would be the winding up process.
Okay. Thank you.
Is that okay? Okay, no worries. Now, in terms of, looking at getting into some of the merit and distinction criteria. So what I've done in some of the slides, which I've got now on the screen, is looking at, the process of insolvency from a point of view of securities regulation. When we talk about companies which have, which are dealing in, say, for example, financial services, or which are involved in banking side of things, you would normally look at, in those cases, sometimes because the companies are not meeting the minimum set requirements and standards, then in those cases, sometimes you would also see that the companies are, landing into court, and obviously their operations have to be wound up because they have not met some of the basic requirements of law. So in this case, when you look at this particular aspect, you would generally see that the securities regulation side of things looks at protecting essentially the members of the public or the taxpayer who have invested their monies in terms of growing the business, or has invested money in terms of buying shares or bonds or debentures for the company. And if we find that the company's operation is not meeting the state stipulated criteria by this Financial Conduct Authority, then in those cases the companies are also wound up, or in some cases companies are levied with fines because their operations are not meeting the rules and regulations which are set in the Securities Regulation. Now, if you look at the global financial crisis which happened in 2008, you would generally see that some of these things, were put into practice when we saw the Financial Services Authority being abolished, and some of the functions of that being taken up by other regulatory authority like the Prudential Regulation Authority, and which led to the subsequent formation of what is called the Financial Conduct Authority. And they were appointed as a regulator primarily to look into the securities framework of regulation to ensure that this, these lapses which have happened in large financial organizations or organizations which are dealing in and providing finance to, various instruments of finance globally, do not lead to this kind of a crisis. So we saw a lot of companies collapsing. Freddie Mac, Fannie Mae in the US. We saw, a few banks collapsing in the UK. We looked at, government coming to shore up some of the operations of Royal Bank of Scotland, the Lloyds Banking Group, and they were all because of some of these organizations were not able to follow, and there were not stringent checks which were done by the Financial Services Authority, and these lapses led to the the global financial crisis. So this could be used as an example to explain, and under the global financial crisis, we could use, say, for example, any particular organization, say, for example, bank in the UK which closed, during, say, for example, the financial crisis, and why they closed is because some of the guidelines and other bits related to the Securities Act, the Financial Services Act, and some of the companies regulations under the Companies Act were not clearly followed, and that led to this particular downfall, and obviously some of the banks going into say, for example, disappearing from the retail or from the streets. So we look at the example of Northern Bank, for example, Northern Rock, sorry, not Northern Bank, Northern Rock, which basically closed down. We looked at Bradford and Bingley. We looked at, obviously, Lloyds TSB, which was rescued by the taxpayer, Royal Bank of Scotland, which was rescued by the taxpayer, HPOS, which was rescued by the taxpayer. The global financial crisis claimed a lot of, there were a lot of casualties, and these were primarily because some of these companies went into insolvency, and that is because of financial irregularities, and that could be used as an example to cover this particular task. So any particular question on this particular part? Okay. So in the case of looking at the merit criteria is asking us to look at advising on the insolvency process in a given situation. So here, what I would suggest is we look at some basic pretext in terms of why a company gets into liquidation or administration, or why a company operations need to be wound up. So when we talk about insolvency, here what I would suggest is we need to come up with some arguments essentially which will allow us to understand the reasons why a company's operation would become insolvent, or why in this case the company would be looking at the process of insolvency because the operations are being wound up. So when we broadly look at, without looking into the slides, why do you think a company operation or a company stops, looks at this or considers this situation to stop its operation? Let's look at some journal points. Why do you think a company or a business would look at stopping its operation?
When their profit is going too low and their expenses, for example, day-to-day expenses, for example, they're paying salaries and rest of things, like expenses, they are increasing, like debts are increasing and their income is really low. That's why.
That's great. So one point that you made is correct, which is when we see the company's business becoming irrelevant because of which the sales and the turnover of the business is declining, profits are declining, that could be one reason. Any other reason that we can think of? Lots of reasons if you look at why a company would close its operation.
Yeah, another one would be if the economic environment is not suitable for that company to progress, they could close down. For instance, if there is war or there is a serious catastrophe,
Correct.
that will affect that company's operation seriously.
Correct. So again, a good point here is that sometimes companies' business and operations would become irrelevant. Its products and services would become irrelevant. It could be because of a corresponding point. It could be because of the external environment in which the company operates. So the first point which Mr. Chima has made is that you look at a company which was producing typewriters, or a company which produces certain type of product is no longer required in the market, so their operations become irrelevant and the company would need to close down operations rather than racking up losses. Any other reasons that you can think of? These are good reasons. These are all good reasons. Any other reason?
New legislations passed in the environment where the company is working.
Excellent point. So today what we see is a lot of companies are coming under pressure because they have to look at meeting environmental standards. So if you look at automobile manufacturers, you look at companies which are predominantly using natural resources, they are coming under increasing pressure because they have to look at compliance, and meeting that compliance means that they need to spend more costs, more profits into coming up with innovative products and services. And in some cases, the cost for R&D to sustain those things is not viable. And you would generally see in those cases, the company or the owners of the business decide either to diversify or close the operations altogether. And that could be one of the reasons that, a company would decide to close down operation. Other reasons that we look at? Any other thing that we can think of?
Could be one reason. For example, we started a new project, like we are trying to start a brand new project, which is like we invested too much in research and development, and because of that now we don't have money to start the project. As project flopped anyway because of the company is going in credit. That could be like lack of working capital, or we have too much loss because of the project. That could be the reason.
That is an excellent point. So basically short of money. So in some cases you would see if the capital runs out, the resources are scarce, in whether we look at administrative, financial, natural resources, manpower costs, or everything is finite. So in some cases you would also look at the company winding up or closing down operations because either the financial side of resources, capital is not available. It could be facing tough competition. It could be because of the market becoming irrelevant. It could be because the company's profits are dwindling. The company, when they introduced, say for example, started to offer, say, services in the market, started selling goods and services in the market, they were the only one, but the competition has caught up, and because of Me Too products or increased competition, you would see the profits of the company are taking a hit, and that it is unable to then generate sufficient profits for it to run the company operations. And sometimes you would see the company directors and owners taking that decision to close down while they're ahead of the curve, rather than go into insolvency and liquidation. Other conditions which could be outside our control. We are in the pandemic right now, coming out of it slowly and gradually. Economic conditions are not suitable for most businesses. We see a lot of businesses which have perished or have closed down and have not been able to sustain because of no business at all during this particular reason, and that is because of the economic conditions which have been levied. And those are the reasons that you would generally see how you would go about advising your clients and businesses, that you look at from an accountancy perspective, that why would you look at diversifying, why would you look at closing down something or do away with something while you're ahead of the curve. And that would be the case of looking at advice that you would need to do or give when companies decide that in this current situation, sometimes, okay, let's look at a practical example. We've discussed, very generically and broadly overarching reasons why businesses would close or decide to close operations or decide to shut. Now, if I look at from an accounting perspective, I look at sometimes my clients come back to me and say, okay, can I ask you to draw me a cash flow statement for the next 3 months, 6 months to look at how do I tide over the business pandemic. A lot of us also help some of our clients to make applications, for furlough, if it was employees on payroll, looking at business bounce back loans, some of the other smaller loans which have been provided by the government for self-employed individuals or, sole traders and partnerships. You generally see that what business owners would have done with you is to sit with you and understand what is the cash flow situation under the current pandemic for the next month, for the next 3 months, 6 months, and 9 months, and whether you are in a position to be able to apply, for the business bounce back loan, because you could apply, to a certain amount of your turnover of the business, and that is where the business, risk mitigation was done by the banks. But because the loans were pretty much guaranteed by the government, what you get to see is that most of them who ended up applying and made an application ended up getting the bounce back loans. So here, as a financial accountant or as a person within this business, your clients would have come back to you to say, could we look at a cash flow statement? Could we look at drawing some projections or do some forecasting for the cash flows that the business would be receiving? And those are the bits that would be then looking at decisively, the owner, the director of the business would then look at those statements and see if the business is drying up, then is it best to close down the business? Is it best to, look at the process of winding up the company operations, because we don't see business happening for the foreseeable future. And these would have been the things that would have been required in terms of, providing the advice and taking the steps to manage this through the process of, a company's closing or winding up the operations. Now, for this particular task, because it's asking for advice, we could give out some of the bullet points, which would basically be disadvantages, which as owners or directors of the company that you would look at if the business is not succeeding, if the market is changing, the profits are going down, the resources are not available, there is tough competition and economic conditions are tough, then in those cases you would look at advising the client on looking at why and how they would go about, closing down or winding up the operations of the company. But we could also look at doing this through a case study. So I've given out a particular case study in the case wherein, a company is looking at borrowing money, and obviously this money is to be repaid back over a period of 30 days. But if it is not repaid over the period of 30 days, then under the contract, the company has signed, it is allowed, or one of the terms and conditions of the contract is if that overdrawn money is not, paid back in the next 30 days and it becomes overdue, then the other company or the client which has provided this overdraft would be free to start the process of insolvency or looking at winding up the company in order to recover that, debt. So this particular task could be looked at by talking about the advice that you would give to an organization or a client or a business in the case if they are looking at seeking insolvency. And the other way of doing that would be through a case study wherein you take up an example and a particular example and then explain how would the process of insolvency entail because of, the client not being able to repay back the debt. Now, the distinction side of things, task which is 2D1 basically talks about analyzing the aspects of capital maintenance. Now, before we go into capital maintenance, anybody in terms of what is capital maintenance? Any idea in terms of what is capital maintenance? When do we use the word capital maintenance? Any idea?
I don't know.
All right, okay. So when we talk about capital maintenance, it is basically related to what is, obviously in the accountancy side, we use this as a particular concept which basically talks about, the principle through which the company's income should be recognized after it is fully recovered its cost. So that means if I put £100 into manufacturing something as a business, or if I look at £100 as a cost, which includes input cost, costs of raw material, cost of manufacturing, and obviously looking at, cost of repackaging, distribution, everything. And then after which, when I sell this particular product, then at some stage, the profit that I realize or the income which the company recognizes after it has fully recovered the costs. So you have invested £100, but after selling maybe 10 of such, product or 10 of such, let's say, items, you have recovered your cost that was initially invested. Then in this case, what I would say is that the capital maintenance, the cost which is required to maintain or recover the cost which has been put into input costs for producing that product would be termed as what is called capital maintenance. Now, why this is important is because...
It's not very clear. Sorry, it's not very clear.
Okay.
So when what do you mean by capital maintenance? Is it after you cover the cost, you take away the initial investment and start using your profit to trade? Or are you saying that after you've invested, you've made profit, you take away the profit and leave the initial investment?
No, it's the first one. When you have invested something into the starting of the business and then you've been able to recover the income, which helps you recognize that the costs that you had initially put in have been fully recovered, then in those cases, anything over and above that would be, would be termed as what is called capital maintenance. So if I talk about the basic definition of it, which basically states that profit should not be recognized until and unless the business has at least maintained the amount which is required to be able to produce those, goods or services in terms of the initial investment which has been done. So when we talk about, or in another way, let's put it in a different way. So when we talk about capital maintenance, what is capital maintenance? There are a set of rules, basically, which under accounting allow us to protect the interest of the creditors of the company. So if the company is making a lot of profit, then before you take out any profits or take out profits as dividends or pay them out as, any sort of dividends to the shareholders, you would need to ensure that the interest of the creditors of the company have been protected. And that concept would be called the capital maintenance concept. Yeah. If your company is turnovering £100, but you have an overdraft, just as an example, if your company turns over £100,000 a year, and you have an overdraft of £25,000 from the bank, for which obviously it's an arranged overdraft, which is normally used, say, for payroll or paying your creditor off, or as a stopgap arrangement at the end of the month when you have your creditors being paid off or their invoices being paid off. That would mean that as the owner or the director of the business, you're not supposed to take that money out unless your creditor's interest has been protected or has been, say for example, the salaries have been paid off, the creditors or the outstanding invoices have been paid off, and then what is left can then be used, as money which could be either used for example, paying off as dividends or taking out as profit, whatever it is. But that amount of money which is required to protect the interest of creditors is basically the concept of capital maintenance.
Okay.
Is that okay? Now, when we look at this particular concept, sometimes when you draw financial statements, we generally see that if the financial year is coming to an end, you would normally see some businesses have outstanding debtors. That means there is debt which is there, but because that debt is manageable, that means you've extended a credit line of 30 days, 60 days, 90 days to some of your customers, but because at the end of the financial year, end of your financial cycle, that debt still remains. What needs to be done is basically you need to account for it in the financial statements, and in order to ensure again that that money, whether it's collectible or not collectible, will the amount of money that you will still maintain in the company basis the debt which is to be recovered, because there is a credit period which has been extended under the agreement, would be required to protect the credit interest of your creditors, and that much money the company should hold in its account or as assets, as retained profits, whichever way you look at it, would be the concept of capital maintenance. Is that okay?
Is that prudent? Is that prudent? Because to me, I feel that if you still have debtors, anyway, depending on the age of the debtors, if we look at the debtors, then there is a possibility that then they will not run into bad debts. Then we say, all right, we can recognize that. Otherwise, I think the most prudent way is that if you have not recovered anything, make provision for it, because we then can tell those debtors might not actually pay.
That is correct. So in this case, the action being that you're taking due care to make sure that if the debtors or those people, they do not end up, paying that, then at least you have made adjustments or at least taken relevant action to be able to ensure and protect your creditors, would be the concept that would apply. That would be called as or termed as capital maintenance.
Thank you.
Okay.
Yeah.
Now, so in this particular task, what we need to be able to look at is, when it talks about analysis, what we need to do is basically explain the concept of capital maintenance and explain this with a bit of an example, giving advantages and disadvantages, that why is this idea meritorious, what are the basic minimum requirements that we need to have when we look at producing these financial statements at the end of the year, or in some cases when we look at the debtors, or basically to customers to which we extend credit, and if they are to become debtors, then how does the rule of, or the the theory of capital maintenance actually apply? And as a general rule, how do we look at ensuring that the owners are not, or the directors of the company are not able to reduce the share capital by reducing the assets of the company, or by selling the stock in terms of shareholders, by increasing by taking away cash by selling the shares, but not ensuring that the creditors of the company are essentially covered. And that would be basically what we need to look at explaining under this. Now, there is a set specific article which I would suggest you to read, and this particular article would put this into a bit of perspective, that why capital maintenance is required or is basically mandatory from a point of view of Companies Act of 2006. Now, if some of us remember that a lot of chief executives of Tesco were actually fined, were jailed. Obviously, the company was fined £250 million by the Financial Conduct Authority, and this was because of over-reporting of profits by the company. So, yes, if I ask you to look at reading this particular article will clarify with an example that what is the concept of capital maintenance, why you need to look at, when we look at talking about large private companies or public limited companies, why is it important as a general rule to ensure that the company has enough cash or assets within its remit to be able to protect the interest of its creditors. And this could be explained, not, I would say this is best explained by looking at an example wherein, you are able to understand this whole concept and why and how this is put into, action and as a requirement by the Companies Act of 2006. Is that okay? So I put a link to this particular article for you to read, which is here, and that would help us basically, cover this particular aspect, of capital maintenance. There is a procedure for public limited companies, public companies, and there is a procedure for private companies, which I've just highlighted with a bit of a flow chart, just as an additional slides. But basically, the task is looking at helping us understand through an example, because it's analyzed, the aspect of capital maintenance, and that would be done through any other example which is related to what I've mentioned, which is basically looking at why these kind of fines are levied to companies. So you look at the LIBOR fine on on HSBC and RBS, which was levied by the Securities and Exchange Commission in the US because of the London interbanking rate, and how banks were actually manipulating that rate to gain profits, or to increase profits at their end rather than passing them on to the consumer and to the bank. When we look at internal lending between the banks within London or different stock exchanges. So taking an example would help you understand this concept.
Will you put the link on this have access to that link regarding the article you are referring to? Or will you
I will put that on, yes, not a problem. I'll put that on.
Okay, thank you.
No worries. So any questions on this particular discussion, the learning outcome 2?
No.
Right, okay, that's great. So let me just quickly go to Adnan. Any questions at your end?
No, not at all, Raman. Thank you very much. You explained everything nicely. Thank you for that.
Okay. Aid, any questions at your end?
Nothing from my end. I'm okay with your explanation. Thank you.
Okay, that's great. So that's the any questions at your end, Udesh? Okay. I think he's texted me. Okay, that's fine. So basically, that's the link which I put in for the London interbanking rate scandal, LIBOR as we call it, and that should allow you to get a bit more detail into this particular reason of why Bob Diamond had to resign. He was termed as one of the leading figures in the financial services sector globally. Obviously, Bob Diamond, if you recall, high-profile CEO Barclay had to resign when obviously these charges were levied, and then Barclay had to seek funding or a bailout through the Qatari foundation, investment foundation, in order to shore up its capital reserve in order to continue banking operations after the financial crisis. So there are lots of such examples which are available. The idea here is, because it's a distinction criteria, it'll be easier for you to use an example and explain the concept, because I've basically explained the concept in the slide, but using an example would nail it, convincingly explain and nail it on that aspect, and that is where I would suggest that you look at one of these to explain this particular or cover this particular task.
Yeah, thank you.
Good stuff. So thanks so much for joining in. I'll make sure that the copy of the recording gets onto the Moodle in the next 15-20 minutes. The presentation is already there. There's not much updates, but I'll make sure that the link to these 2 articles is also placed separately under the Learning Outcome 2, and that should allow you to visit the websites and basically read for a bit more detail.
Thank you very much for that. Thank you.
So when